So I'm joined today by Bertie Butler, an investment manager at Quilter Cheviot. We're going to be discussing active v passive investing. Bertie, could you explain active v passive in plain English?
Yeah, sure, absolutely. So passive investment is hands-off investing that tracks an index like the UK or the US stock market, or an asset class like, say, UK corporate bonds that you're investing in. It's typically low maintenance and therefore low cost, and takes away any ability to out or underperform that specific market. Active investment is more hands-on. With active investment, you're attempting to beat the market whilst also obviously opening the door to not doing so. This involves more work from investment managers and research teams alike, and so typically comes with additional cost compared to passive investing. I've always enjoyed the London black cab analogy. An Uber will cost you less than a black cab, but the Uber driver has not taken the knowledge of London exam, meaning they will tend not to know the roads quite as well and will therefore be following their map. A black cab driver, he or she knows the roads like the back of their hand, and you're banking on their local knowledge being able to beat your Uber driver's ETA, whilst also getting, hopefully, some reassuring commentary along the way when you hit the inevitable traffic jam.
So I really like the analogy of the black cab. Do you have any examples that you could go through of where active management has really helped you?
Yeah, of course. So passive investing has grown from around 10% at the turn of the millennium to well north of 50% now. But nevertheless, the dot-com bubble bursting in March of 2020 provides a really good example, as being invested through ETFs at the time meant there was no way of avoiding the capitulation that was seen in unprofitable tech companies. And whilst there wasn't much room to hide for any investors, active managers were able to navigate away from the most speculative tech companies, thereby avoiding the worst of the falls. Passive investors were a bit stuck. Do I stick with passive, or do I switch into a more active solution? Or more broadly, do I stick with staying investing at all and move to cash potentially? Active managers are flexible in terms of what they can do during volatility, and can also provide guidance to clients around the benefits of not panicking, staying invested through times of turbulence. Timing your exit and entry to the market is often tempting, but more often than not, it's a bad call with the benefit of hindsight. And having an investment manager who's been through it before can help calm the very natural investor nerves. A more recent example was during the early stage of the pandemic, where an active manager was able to exit or avoid positions such as Carnival, let's say. Carnival is a cruise line operator. Clearly, they were going to run into a tough few months, if not years, when the world shut down, and we were able to use those funds from exiting those positions to add to companies that were deemed to be beneficiaries from, say, the move to working from home, such as Microsoft. That's a change that passive investors are not able to benefit from.
ETFs and index funds have become incredibly popular, and is there a case for using them in your active portfolios?
Yeah, it's a very good point. And I think at this point, it's really important to point out that as active managers, we are able to use passive investments where we deem it appropriate, as well as active funds or direct shares. In short, we can be totally flexible, but it's really important to point out that being active does not exclude passives from our investable universe. Being flexible has helped us in the past, and the so-called Magnificent Seven, Apple, Amazon, Google, etc. They, over the last 10 years, they made up a higher and higher proportion of the US market. About 10 years ago, it was about 10% of the market. It's over a third today. And so keeping up with this level of outperformance and concentration from an extremely select group of stocks has naturally been extremely tricky. And therefore, the ability for us to own tracker funds for our US equity component for clients has been of huge benefit. ETFs do have a lot going for them, though, and clearly with low turnover and low administration costs, their low-cost nature is attractive to many investors. There are studies to show how well they've done, but a fair amount of this has been due to the aforementioned Magnificent Seven's relentless march upwards, and also the lack of many substantial and long-lasting market pullbacks in recent time. But as we know, these themes are unlikely to last forever.
One concern with passive investing in ETFs is that it funnels money into yesterday's winners. Do you think that there is an issue with investors being exposed to downturns in this situation?
Yeah, I mean, I've touched on the dot-com bubble where passive investors were overly exposed to unprofitable tech companies that subsequently sold off disproportionately to the rest of the market. But another example would be banks. in the build-up to the Great Financial Crisis. If you own the largest companies in the UK through a passive the day before the financial crisis kicked off, you'd have had around a quarter of your money in a handful of domestic banks. Only 2 years later, not only had the number of banks and the index fallen from 9 to 5, but the sector's share had fallen to under 10%, resulting in passive investors taking on a lot of avoidable pain. We, as active management, place a great deal of time and effort into the valuation of stocks, and studies have shown that the highest valued stocks underperform the opposite over the long term. And as active managers, we can sell stocks, even if we still like them, when they become too expensive, and buy them back at cheaper levels when the market naturally corrects. And this is quite topical at the moment, with the market getting excited around a number of stocks deemed potential AI winners. One thing we know from previous booms, such as the railways or the internet, is that not all the incumbents will win, and new entrants will enter the market and take share. Being flexible at times like this, we think, is vital for long-term returns.
So if somebody was trying to make the decision about whether to go into an all passive portfolio and run it themselves or give it over to an active manager, what would be the key themes to help them sum that decision up?
Yeah, I think I can summarise my points into 3 key areas. The first is flexibility. And I think the key point here is that an active manager has the flexibility to invest in anything. Passives, direct shares, whatever it may be. And that opens up a number of doors to generate long-term outperformance. There are also less talked about benefits of flexibility as well, arguably more on the financial planning side, such as the ability to put income-producing investments in accounts such as ISAs rather than taxable accounts, or even a spouse's name if they're a lower-rate taxpayer. Secondly, the added cost of active management is often thrown around as a reason to invest passively, but it is worth remembering that unless the passive investor is happy to invest 100% of the portfolio in equities and can therefore put everything in a global equity ETF, they will still need to pay someone to make asset allocation calls on their behalf, adding a layer of cost. Some of the more specialist ETFs also now come with near active levels of cost themselves, whilst the cost of discretionary portfolio management and MPS solutions has come down over the last few years, meaning in reality the cost between active and passive is smaller than what is often banded around. Finally, today, in the time of AI, the debate is very topical, with certain segments of the market seemingly at stretched valuations. It's been periods such as these in the past that have led to lengthy periods of outperformance for active managers. And so we feel today is a good moment not to be exposed to all areas of the market as a passive investor would be.